You will recall these 6 steps of the accounting process from Floor 1. In this section, we will emphasize steps 4, 5, and 6 as we review the preparation of the income statement. The raw materials of an income statement are revenues and expenses. Revenue and expense accounts are classified as shareholders' equity. As transactions occur and are analyzed, those affecting revenues and expenses are recorded in the journal, and then any changes are posted to the revenue and expense accounts in the general ledger, just as with any other transaction. At the end of the accounting period, revenue and expense accounts are adjusted or updated to reflect changes in assets or liabilities resulting from transactions that are incomplete as of the period's end. This adjustment process is a necessary component of accrual accounting.
Here is an unadjusted trial balance. Does this trial balance capture all of the revenue and expense generating activity necessary to prepare an income statement for the period?
Correct. In addition, there are ongoing revenue and expense transactions whose effects have not been entered into the accounts. These require updating or adjustment.
A bank lent $10,000 to a customer on December 31st of last year in exchange for a note receivable. Payment of the note, plus interest at 1% per month, is due on March 31st of the current year. In order to correctly determine interest revenue for January and February, the bank should recognize $100 of interest revenue for January and $100 of interest revenue for February. Using the balance sheet equation format, what would the effects of this transaction be on January's financial statements? Please fill in the correct amounts. The firm has earned interest revenue of $100 and has the right to receive $100 when the note comes due.
The accounting period closes on a Wednesday. Payday for the previous and current week is the following Friday. While there will be no cash payment until Friday, which is the next accounting period, the firm has received services of its employees during the accounting period just ended. Therefore, payroll expense should be recognized.
You are correct. A tenant paid $36,000 of rent for the entire next year in advance on December 31st. The landlord has an obligation to provide the tenant with use of the premises. As each month passes, the landlord earns revenue and the liability advances from the tenant decreases. The $36,000 cash received is an asset, and the landlord has a $36,000 liability to provide the tenant with the use of the premises. $36,000 annual rent is $3,000 per month. The landlord earns $3,000 per month for providing the premises to the tenant. Of course, the liability decreases as the services are provided. The future benefit provided by fixed assets expires as time passes. For example, a truck that is 3 years old presumably offers a firm less future benefit than a new one. Depreciation expense is an estimate of that portion of the fixed asset's original cost that has been used up in the current year's operations. You are correct.
Let's look at the machine example more closely. The column labeled Accumulated Depreciation represents the cumulative amount of depreciation taken through the end of the year. Each year, as depreciation expense is recognized, the asset machine decreases by $5,000. Accountants often used another account, accumulated depreciation, to report the machine's book value on the balance sheet. The accumulated depreciation account is a contra asset account because it contains subtractions against another account machine. Contra is Latin for against, as in contrary. A contra account always has a balance on the opposite side of the parent account.
You are correct.
The adjusted revenue and expense accounts, as shown on the adjusted trial balance, are reported on the income statement. The resulting net income increases the amount in the retained earnings account. Of course, if expenses exceeded revenues, a loss would occur, and the retained earnings would go down. After preparing the income statement, the accountants transfer the adjusted revenue and expense accounts to retained earnings, so that the revenue and expense accounts have a zero balance to get ready for the next accounting period, and the retained earnings is updated by the period's income or loss. The revenue and expense accounts are said to be closed.
Correct. Interest is incurred as time goes by. As of the initial date of the loan, the company has received no benefits and, therefore, has neither a liability nor an expense.
You are correct.
Sorry. The adjustment necessary is classified as an accrual of an expense, because cash will be paid later. Very good. Interest expense represents the 15 days beginning April 16th and ending April 30th out of 30 that the company has used the funds. $100 times 15 divided by 30 equals $50.
T accounts could have been used to represent the effects of the previous adjustment. How would you represent the accrual of $50 of interest in the previous example? Use your mouse to correctly show the effects of the transaction by dragging and dropping the amount to the appropriate side.
Sorry. You are correct.